All right, we're going to talk a little bit about flexible budgeting and or, excuse me, building a variance or doing what's called variance analysis. Now, in essence, this really builds on what we did in the last chapter, which was start with a master budget. And if you remember, when you build a master budget, it's all predicated, all built on one basic assumption, and that is what's going to happen with respect to sales. And we're going to assume that sales and production are equal. So if you predicted that sales are going to be 25,000, fine, you build your master budget based on that. Well, invariably, one of the things that's going to happen is that your sales and production are going to be different. There are a lot of internal events that can occur that you simply didn't predict that can make your sales go up, that can make your sales go down. So you're always left with sort of the real quandary, how do I know if I'm doing things properly? Or more succinctly, how well did we do? I already know that my sales are different than what I thought. And we're not going to look at that aspect. But rather, what about in terms of production? Was I able to control cost, both with respect to materials and labor? And that's really the essence of this chapter. Now, first of all, we'll take a look at some of the questions here. The issue here, one would be, how do I define a variance? Well, a variance is really nothing more than something that's different than what I predicted. If my budget calls for sales of 20,000 and I sold 22,000, I have a variance. Now, that's good. I mean, to sell more. Now, the issue of favorable or unfavorable means it not good or bad for a company, but rather what's the impact on profit. So, for example, if my prediction was to sell 20,000 units and I actually sell 25,000, well, my revenues are going to go up. My profit will go up. That would be defined as a favorable variance. Conversely, if I predicted 20,000 units in sales, I sold 15, okay, my sales are going to go down, therefore I will have less profit. That would be considered unfavorable variance. Now, with respect to cost, if at a sales level of 20,000, well, actually, let's go back and look at it in terms of, we're going to use some of the basic inputs from variable costing. So if I pay more cost than what I predicted, then the impact of that is to reduce my profitability. My costs are going up, that would be an unfavorable variance. If I can do the same thing with less cost, then that would be a favorable variance. And we'll look at that. That's very general and may not make a lot of sense to you, but we'll look at some actual examples of that here when we look at this, okay? Now, a flexible budget allows you to create a what if. And using a lot of the basic inputs from variable costing. And so really all a flexible budget is to say, okay, let's take a look at the actual level of sales. Forget about what we predicted. What is the actual? So if I take that actual level of sales and multiply it times my variable cost, that is my direct materials, my direct labor, all of my indirect variable cost. I can also plug in my fixed costs because, again, those shouldn't really change with small or modest changes in production. But those, I can look at I can now have a better way of comparing my actual results against a budgeted amount. I already know if I look at my actual versus my master budget, my sales didn't match up. So let's match it up in terms of sales. Let's allow my production costs, particularly the flexible ones, the variable ones, to scale upwards or to scale downwards based on my actual production. And so that's really all the flexible budget is building that so that I can compare my actual against a budget. And that's really the essence of budgeting or analysis, is to look at the actual results compared to what they could be or what they should be. All right, before we look at the actual problems, we're going to look at one final question here, and that is variance analysis really should not be used to pin blame or to point fingers at people. Rather, the question is, what could we do better? We know that we have a problem, potentially, because we've identified a significant variance. And we'll get into how to do that here in a few minutes. Okay? But the issue here is not necessarily one of blame, but rather one of solutions. So when you identify a material of significant variance, the question is, what are we going to do about it? How are we going to solve this problem? So if you begin to pin blame on things, you're really not really trying to solve the problem as much as you are trying to demean a person. So while a person may be responsible for that, and that responsibility does not go away, the issue here is one of solving a problem to make the company more profitable. All right, in this chapter, we're going to look at calculating variances basically with respect to direct materials and direct labor. And so we're going to focus on a couple of problems here, starting with a sort of a simple one, but still a challenging one, looking at direct material variances. If you can do direct materials, direct labor really essentially the same thing. But part of the challenge here when you do these kinds of problems is to make very clear that you understand a lot of the basic inputs here, okay? And so, again, they're looking at the flexible budget variance, the difference between what the flexible budget said we should be doing with respect to materials and what we did. We can look at some other issues here as well. All right, well, let's look at the first issue here, number one, which is looking at compute the flexible budget variance. As I said, we're really not going to worry so much about the so-called sales volume variance. We already know that. And that is they predicted sales of being 60,000 scones. They came in at 60,800. Okay, fine. We can look at issues with respect to materials. But let's not really worry too much about that. But let's start, first of all, with the flexible budget. And this is where we're really going to focus here in this chapter is building the budget, looking at comparing the flexible versus the actual with respect to materials and with respect to labor. So the starting point, if you will, would be the flexible budget. Given that the output is 60,800, okay, and given that with each unit, I'm allowed 1/4 of a pound, and given the actual price that I'm allowed to pay, then this is the amount that I should come up with, which is also what they've calculated here in Part B. So if I take the 60,800, my actual production, okay, times the 1/4 of a pound of pumpkin, times what I'm allowed to pay here, namely 89 cents, and that is going back up here, this is kind of what my input was here, then according to my flexible budget, at that level of production, I should be paying $13,528. Now what we're calculating here is the total budget variance with respect to materials. We don't know what's price, we don't know what is efficiency. My actual results are going back to, well, okay, how much did I buy? Well, remember that the flexible budget said if you're going to produce 60,000, you should be buying 15,000. So that's where the 1/4 of a pound comes from. But in this case, the 16,000 was the actual purchase, and they again the actual purchase, the actual amount times the actual price. So if I take the 16,000 times the 82 cents, this is the amount that I have here. This is what I should have, okay, given the inputs that I'm working with, given my standard. Sometimes this is referred to as standard costing. So at 60,800, at an allowance of 1/4 of a pound, okay, then I should be at 89 cents, okay. This is what I should have. This is what I came in with, a little bit less, okay. So you can kind of see if this is what I should have and this is what I have, that they came in a little bit under budget, so that would be defined as a favorable variance. Now, what I don't know, and how much of this might be attributable to, did they pay more or less than what they thought? Did they use more or less than what they thought? Now, sometimes those two things can go in the same direction. Sometimes they can be going in opposite directions. And so we need to, as they say, decompose the material variance into both its price and efficiency components. And that's kind of what the next step is here. Now, I kind of learned what I call the 3-column format rather than the algebra form. We already know what the two outsides. If I take my actual quantity at the actual price, APAQ, actual price on a quantity. If I take my standard price times my actual quantity, I come up with this amount. Okay. Now, again, what I want to do here, excuse me, this is my standard quantity times my standard price, okay? Given the number of units that I produce. So that's why I take the 60,800 times the 1/4, okay, times the standard price. Now, what I want to do here is to build in this third column, okay, the middle column. And this is basically made up of my actual input, my actual quantity, times the standard price. Because what I want to measure on the left is my price variance, and the right, my efficiency variance. So the actual quantity that I used here was the 16,000. And since the standard price was 89 cents, comparing the two here, the 14,240 versus that, oh, okay, yeah, I'm spending a little bit less, and you could kind of see that. 89 cents is what I budgeted for, and I paid 82. Okay, very clearly you can see they're paying a little bit less, so that generates the positive or the favorable price variance. Now again, this is the standard, this is the actual quantity times what I'm allowed. Okay, again, if I produce 60,800 units, I'm allowed 1/4 of a pound, and I'm allowed to pay 89 cents. That's where that comes from. And it's always based on the actual quantity that you produced times what you're allowed. Now, if I compare that, okay, the 13,528 versus what I came up with here, okay, I'm overpaying. I'm using a little bit more material than I should. This is measuring, did I use more or less material than I should? This is measuring, did I pay more or less than what I thought? As you see that sometimes you get these two things offsetting each other. So you may look and say, well, I don't really have a big problem with my overall variance, but in reality, I can have some very significant material price and efficiency variances that are offsetting each other. So it's not a bad idea to always decompose the flexible budget variance into the price and efficiency variance. Okay, we're going to take a look at problem number 25, primarily because it is a little bit more comprehensive problem looking at both material and labor variances, both with respect to price and efficiency. And as an additional follow-on to this in number 26, look at it in terms of the actual journal entries that are required with that. Because I said, not only are we calculating variances, but we're also doing what's called standard costing, where I'm going to keep all of my inventory, regardless of whether materials, finished goods, work in process, at the standard cost. And any variance would be recognized immediately. Now, in the end, I have to bring everything back to full cost. We'll talk about that when we get to problem number 26. But variances are done not just simply as an audit feature, but they're done to separate out the variances and allow you to carry the inventory at the standard cost. Now, when I do these problems, I always kind of like to make sure I'm real clear about some numbers. One, if you can read my writing here, that they produced 2,000 units. Again, they're producing chairs, it doesn't matter. Now, with respect to materials here, they're allowed, okay, 2 yards per chair, and they're allowed to pay, the standard would be $5 per yard. So again, if I produce 2,000 chairs, I should be using 4,000 yards. Okay. My labor standard, what I'm allowed to use, is half an hour per chair, and I'm allowed to pay $10 per hour of labor. So if I do things right, if I produce 2,000 chairs, I should only be using 1,000 hours. All right, so we'll look at that. Now, I come down here and say, okay, well, fine. What did they do? Well, they bought and they purchased 3,700. They paid $510. Okay, the actual labor costs were $88.20. The actual input, what they actually used, was 900 hours, and they paid $980. So don't worry too much about identifying variances or anything at this point right now. Okay. Now, what we're going to look at is in terms of direct materials to start with. And again, I like the 3-column format. So I'm going to take my actual quantity, go back up here, and make sure I'm clear about that. I could even have another little matrix over here the actual quantity of 3,700 yards, the actual price was 510. So that's what I take, 37 times 510. Fine. The middle column here, because let's just start with the price variance here, is my actual quantity and my standard price. So the differences here are the matters of price. I'm focusing in on, did I pay more or less? Well, you can see they paid a little bit more than what they're supposed to, 10 cents, okay? And by the very nature, if you pay more than what you should, you're going to generate an unfavorable variance. It's going to increase your cost, lower your profitability. Now, on the other side here, okay, what they're building here, and this is important, I need to look at my actual production times what I'm allowed. And it wouldn't matter whether it was 5,000 chairs, 2,000 chairs, whatever. So if I produce 2,000 chairs, my standard allows me 2 yards. And likewise, my standard allows me to pay $5 per yard for those chairs that I'm producing. So if I produce 2,000, I'm allowed 4,000 yards at 5 or 20,000. That's what I'm allowed. Now, again, if I look at this, I say, okay, they're using considerably less yards than what my standard allows me. We're not here to answer the question why, but rather let's just isolate the variances. So if I'm using less material, okay, I'm going to generate a favorable variance. So my solution here, the net of the two, my flexible budget variance with respect to materials is 1130 favorable, but it's made up of a unfavorable price variance, but a favorable efficiency variance. Okay, essentially I'm going to do the same thing with respect to materials. Bring down all of these inputs that I have up here. And that's why I said it's real important when you do these, whether you have a sheet of scratch paper, whether you do it in your head, whatever, what are the numbers I plug in? Well, I bring down my actual number of hours, the actual quantity at the actual price. That's it. It's the 8820. So I bring down my actual quantity, and I bring down my actual, my standard price. I'm allowed to pay $10. So again, kind of comparing the two here. 9,000 is what I'm allowed. That's my budget. I came in at 8820. Okay, I spent a little bit less, but I mean, you can kind of look at the amounts here. The 980 versus the 10. All right, fine. They paid a little bit less, so we have a favorable price variance. Now, on the other side, the quantity issue. Am I using more or less labor than I should? Well, again, I go back to what my standard allows me. At 2,000 chairs, I'm allowed, as I talked about a little bit earlier, half an hour per chair or 1,000 hours. Likewise, I'm allowed to pay $10 per hour. So if I produce 2,000 chairs, my standard allows me to add, in fact, I will a little bit later on with the journal entry, to costs in terms of labor at $10,000. Well, I actually paid $9,000. So I have, in a sense, kind of an efficiency variance. I'm using less labor. I'm paying less than I should, and I'm also using less than I not that I should, but I could. We'll use those two terms. So these two things are additive. So I end up with a $1,100, $1,180 favorable total flexible budget variance with respect to labor. Now, we're not going to worry too much in terms of how, when, why these things can occur. The textbook gives you some examples where they discuss, well, why might this happen, where you would have a price variance? Why might you have an efficiency variance? In many cases, we're kind of coming in out of the blue. We have no idea. So it's pure speculation. But again, within a company, if you deem the variances to be material, in many cases they probably are, then the manager is simply going to, again, we're not here to pin blame, but rather to explain why did the variances occur? And what are we going to do in the future to prevent variances from occurring? Again, don't get the idea that favorable is always good. Sometimes it's simply favorable and unfavorable is simply the impact on profit. A favorable variance, I mean, I can save money on inputs with materials, but I might be buying less quality, something of a lower quality that's going to break, that might be defective, that could, so my sales down the road could go down. So don't be confused by the idea that, oh, favorable is always good. Now, there are times when you can actually separate out the price variance from the usage or the efficiency variance. For a lot of reasons, companies will sometimes buy considerably more materials than they need. Perhaps they think there's going to be a shortage. Perhaps they think the price is going to go up. So while they didn't need all 6,000 yards, in fact, they only needed at most 2,000, okay, or excuse me, 4,000. So they bought it extra. And so again, there could be strategic reasons why they want to do that. And that's fine. I can isolate the price variance and, in a sense, okay, separate out the two. Well, one, because of responsibility, that oftentimes the price variance is not the production manager's issue, rather it's the purchasing department. They're given purchase orders, they're told what the quantity is that they need to purchase. Did they buy the right quantity? Did they buy the right quality? So again, if they buy 6,000 and they pay the 510 versus 6,000 at 5, okay, they have an unfavorable price variance. And again, maybe they pay the extra because if they waited, it may go up to 550. So there are a lot of reasons why they may do that. Now, again, this could be the purchase manager. This is going to be the production manager. The efficiency variance would be exactly the same that we did before, where I'm going to look at the actual quantity that I'm allowed 2 yards per chair at 2,000 chairs at $5, 20,000. They use 3,700 yards at 5. So they, again, the favorable variance doesn't change. The efficiency variance is not going to change if you separate out the price from the efficiency. Now, what are the other elements that you can do and must do with standard costing? And really the whole reason to do it is that you want to isolate variances and decide if you're going to deal with them at the time that they occur. And the other thing is I want to keep my inventory at standard cost so that variances cannot be hidden. Otherwise, if I don't do standard costing, I can have huge efficiency problems. I can have huge price problems, but I have no idea that they're occurring until I get to the end of the year and look at, well, why is my profit different than I thought? These things all get buried into cost of goods sold. So the standard costing forces management to confront and deal with variances when they occur. Now, they can simply say, hey, it's not material. We're not going to worry about it. Okay? But the other thing that's important here, and this is a hard thing, I think, sometimes for students, that under standard costing, I keep my inventories, materials, work in process, finished goods, cost of goods sold, at the standard. Okay? Well, it doesn't matter what kind of variances I get. I keep everything at standard. Now, at the end, I close out my variance accounts to cost of goods sold, very much like we've done with overhead, so that those variances don't get left out there, but rather they come back into cost of goods sold. And if they're material enough, I may have to prorate them between work in process, finished goods, and cost of goods sold. Now, this is looking at my materials inventory, this entry right here. We'll call that number 1 or 8. And so material inventory account, going back up to when we purchased it, okay, the 3,700 yards at $5 per yard, okay, I keep my materials at standard, okay. Likewise, too, if I look at what I actually paid for it, okay, I paid the $18,870. Okay, that's essentially is going to be my accounts payable. The difference here, this variance, okay, and you can kind of think of an unfavorable variance as being like a debit, okay, kind of like an expense. A favorable variance is kind of like a revenue, okay, because a debit, an expense reduces profit, a credit or a revenue increases profit, if you want to think of it that way. I have a variance that I have to deal with here. And so management is going to get these printouts, okay, or get these on their screen once a week, once a month, and they're going to have the sum of these. And so they're going to have to make a decision. Are we going to review this? Are we going to go back and make some modifications? Or do we say, okay, this is not something that we're going to be particularly worried about? Now, keep in mind, variances are going to occur. Yeah, there's no such thing as perfect production. Variances are going to occur. It's up to management to decide if the variance is material if they warrant investigation, if they warrant changes. But materials, okay, are held at standard, okay, and they're going to get released in terms of standard. Now, work in process. Okay, the materials, okay, when they take the materials out, they're taking out 18,500. Okay, that is all that went in. All of it goes into work in process. It's released. And this is the problem. Okay, I'm essentially going to bump up, if you will, my work in process by $1,500. Because if I'm producing the 2,000 chairs, I'm allowed, okay, 2 yards per chair, okay, that is 4,000 yards at $5, $20,000. This is a problem I think most people have an okay with, oh, okay, fine, I have to kind of recognize this part here. But the idea of increasing inventory is kind of counterintuitive in terms of accounting. But with standard costing, I keep my work in process and hence my finished goods and cost of goods sold at the standard. And so in this case, because I'm using less, okay, that efficiency variance, okay, I recognize as a credit entry. Again, it's okay. You can write up inventory, okay, and you're going to under this. Now, doing labor variance is a little bit more difficult, primarily because here I can look at kind of the input, here I can look at the output of labor. And that is, this is going into my direct materials, hence my price variance. This is what's going into work in process, hence my efficiency variance. But with labor, I can't do that. I have to look at it sort of as a compound entry. And so my suggestion is to say I could do the same thing with my material variances. That work in process is always going to be at standard. So in this case, because I'm producing 2,000 chairs, and my standard allows me half an hour per chair, and I'm allowed to pay $10 per hour, that gives me the $10,000. Okay, now that's what I bring it in. On the other side of the equation, well, what did I actually pay for labor? And that's where you calculate the 900 hours at 980. All right. Well, what I also know from when I calculated variances, that with respect to labor, I have two favorable variances. Okay, a favorable variances has to go in as a credit entry. So I need essentially to bump up the credit side to equal the debit side. So the labor price variance, small, okay, 180, but it doesn't matter. I have to make the entry here. And then likewise, the efficiency variance for $1,000, okay, the sum of these equals $10,000. Again, I can bump up the amount of inventory, be it work in process, be it finished goods, be it materials, to equal the standard amount. All right, I'm not going to go through all of the T accounts. You can look at those if you like to kind of see how they do the debit and credit part of it. I think if you can kind of understand what they're doing here. Again, the whole idea here is that under standard costing, I'm required to keep my inventory at the standard cost. Now, yes, I know at the end, GAAP says everything has to come back to total cost, and I will do that. But we're not going to worry about those reconciling entries at this point. This is these are my T accounts right in here. Now, this is looking at if I isolate the price variance at time of purchase, fine. Bring in direct materials at the standard, okay? I paid a little bit more, so that's the account payable. And so, fine, I have an unfavorable price variance. I'm going to have to make a debit entry there. Again, I can still do the same thing. And these entries down here with respect to the usage, even if I'm separating out the price and efficiency variance, they're going to be exactly the same as I did above that. Okay, so that pretty much concludes what we're going to do with the variance analysis. We're not going to look at sales variances, but we're going to really focus in on the labor and material variances, the flexible variances, and how you can decompose those into a price and efficiency variance. That's really the essence of the chapter, and that's primarily what we're going to focus on. I've given you some solutions here that you can take a look at, that if you want to look at more problems, you have it, all 67 pages here. So feel free to do whatever you like there in terms of looking at additional problems.